It's time to learn to analyze the market. You've already met the bull and bear markets. Now it's time to go deeper. Understanding how they form and what drives them will help you anticipate market moves. By the end of this lesson, you'll know how to identify trends, recognize cycles, and use them to your advantage. Let's get started. In a bull market, prices don't rise in a straight line. In a bear market, they don't just fall non-stop either. Markets move in waves, small ups and downs that happen inside a bigger trend. In a bull market, this might be a market correction, a brief pullback before the climb continues. Think of it as a quick pause to catch your breath during an uphill hike. In bear markets, a short-term bounce is called a relief rally. They are like a temporary break in a steep downhill run before the descent continues. Recognizing this behavior within a larger trend helps you manage risk and make smarter trading decisions. A market correction is a short-term dip in a rising market. Experienced traders see it as a buying opportunity, a chance to enter the market at a lower price before the uptrend continues. Imagine Jane, a trader, is watching General Motors, a stock that has been steadily rising for months. The stock recently hit $70, but then it dropped to $60 over a few days. Some traders panicked and sold, fearing a bigger drop. But Jane recognizes this as a market correction, not a crash. She waits for signs that the stock is stabilizing, then buys at $65. A few weeks later, the uptrend resumes, and the stock climbs to $80. By understanding market corrections, Jane bought low and made a profit of $15 per share. On the other hand, a relief rally is a temporary bounce in a falling market. It can trick traders into thinking the trend is reversing, but experienced traders stay cautious, knowing that prices may continue downward. Now Jane is watching the stock of Google in a bear market. The stock has been falling for months, dropping from $200 to $160. Suddenly it jumped to $170 in a single day. Some traders believed the trend was reversing and rushed to buy. But Jane recognizes this as a relief rally, a short-lived bounce in a downtrend. She waited instead of buying too soon. A few days later, the stock fell to $160, confirming that the bear market was still in play. By staying cautious, Jane avoided a costly mistake. Not every dip in a bull market is just a correction. Sometimes it signals a deeper decline. So how do you know if it's just a dip or the start of something bigger? Here are the signs of a market correction. The overall trend is still upward. Each bounce goes a little higher than before. The decline is less than 10% and recovers within days or weeks. No major negative news affecting the market long term. Sometimes a dip is more than just a correction. It could be the start of a bigger downtrend. Here's how to recognize a deeper decline. The trend breaks down, lower highs and lower lows appear. Each bounce goes a little lower than before. The drop exceeds 10% and lasts for a long period. Negative economic news or financial instability triggers fear. Knowledge check. Market correction or a bigger downtrend? Let's put that knowledge into action. Imagine you're a trader analyzing a market trend. Choose 3 signs of a market correction. Excellent. On the contrary, a relief rally can also trick traders into thinking a bear market is over. But how can you tell if it's just a temporary bounce? Prices rise fast, but not many people are trading. The overall downtrend remains intact, lower highs and lower lows, no major improvements in the economy or company performance. A true trend reversal signals the end of a bear market and the start of a new uptrend. Here's how to tell the difference. More traders are buying, increasing demand and trading activity. Optimism returns as the economy improves or positive news boosts confidence. Knowledge check. Relief rally or a true trend reversal? Let's practice. A sudden price jump can be exciting, but don't be fooled. Can you tell if it's just a relief rally? Pick the signs that suggest the market bounce is temporary. Nevertheless, markets don't stay bullish or bearish forever. They move through cycles, just like the seasons. Just like spring brings growth, summer peaks, fall slows things down, and winter resets before the next cycle, markets follow a similar rhythm. Then the market hits its peak, just like summer at its hottest. Stock prices are at record highs and investors are overly confident. But warning signs appear: rising inflation, slowing growth, or interest rate hikes. Smart traders start taking profits before the market shifts. Contraction is like a fall. The market cools down and stock prices begin to drop. Investors start selling, uncertainty rises, and businesses cut back. While some panic, experienced traders prepare for the next cycle. The trough is like winter. The market is at its lowest, but recovery is near. Stock prices stabilize, value investors start buying, and economic conditions slowly improve. Traders who recognize this phase position themselves for the next expansion. Every market goes through these cycles. Recognizing where you are helps you make better trading decisions. In expansion, traders ride the trend. At the peak, they stay cautious. During contractions, they protect their assets, and in the troughs, they look for opportunities before the next uptrend. Knowledge check. Market cycles. You've learned how markets move just like the seasons, expanding like spring, peaking like summer, cooling like fall, and resetting like winter. Think like a trader and match each phase with its characteristics. Now you know how to spot each phase and trend and use them to make smarter trading decisions. Keep practicing, and soon you'll spot market trends like a pro. You are one step closer to beginning your trading journey, so keep up the good work. It's time to explore trading sentiment. Markets aren't just moved by numbers or charts, they're driven by people. In this lesson, you'll learn how emotions, crowd behavior, and overall market psychology influence price movements. You'll also discover how to read and respond to this hidden layer of the market. Trading sentiment is the overall mood of market participants. Are they confident and optimistic or fearful and cautious? This emotional tone, whether bullish or bearish, helps explain why markets move the way they do, often before technical or fundamental factors catch up. Even when a company has strong fundamentals, if the sentiment is negative, its stock price can fall. On the flip side, hype and excitement can push prices higher, even when the actual data doesn't support it. Understanding sentiment helps traders anticipate short-term shifts and avoid emotional traps. Two emotions dominate trading: fear and greed. Greed drives traders to chase prices higher in fear of missing out. Fear causes panic selling when markets turn. These emotional extremes often mark turning points. Smart traders learn to spot them. Imagine a stock that has doubled in a month. Everyone's talking about it. That's greed. But when it suddenly drops 20% and investors rush to sell, that's fear. Spotting these extremes early can help you avoid buying at the top or panic selling at the bottom. You can't directly measure emotions, but several tools give insight into how traders feel. These include the Fear and Greed Index and Trends in News or Social Media Sentiment. Each helps paint a picture of the market mood. The Fear and Greed Index is popular and it tracks 7 indicators, including volatility, momentum, and market breadth.